Good morning, ladies and gentlemen. Well, the risk dial is stuck into the 60s, and we're not going to learn anything at all from the risk dial over the course of the next few weeks. We probably have another 20 days until things start getting a bit dodgy. So in the meantime, it's still equities over bonds, and that is very unlikely to change and is likely to remain in a very tight range for the foreseeable future, certainly for another 20 days according to history, and then things could get volatile. But for the time being, equities over bonds. Well, we finally have the new dot plots, and let's have a look together at what they say. So, they've revised up the real GDP for both 2024, 2025, 2026, and the longer run they've they've kept it the same. The unemployment rate, they haven't really moved it. They think the central tendency is still very much around 4 and not much higher than 4. If it gets to 4.1, 4.2, that's only 0.2 away from where we are at the moment, so it's really not significant. What they have done is they've revised upwards slightly the 2025 PCE, but otherwise they've held it, at the same levels as before. And what have they done to the projection of the Fed funds rate? The median has gone up 1 in 2025, gone up 1 in 2026. And to me, what is significant is they're starting to move the longer run from the 2.5 slightly higher. Why is that significant to me? Because what they're saying is that they don't know where R star is anymore. Don't forget that they've held this at 2.5 all the way throughout 2022 and 2023 when inflation started going up. And now, when inflation is down, they're saying that they don't know whether it's at 2.5 anymore that R star is, but it could be higher. Well, how much higher could it be? They don't know. They haven't got a clue. But they're saying that the odds are that it's higher. Okay, so if they're saying that the odds are that it's higher, that means that the terminal rate, the odds are that it's higher as well. So why would anybody want to buy long-term bonds here is really beyond me. Because what they're saying is that 2.5% is the new 2%, but it could be 3%. So to me, inflation is likely to be sticky above the 2% target. It's probably likely to be 2.5% plus, and they are happy with that. They're saying that that is quite reasonable and that that is good enough for them to start cutting. Is that a big change? Well, I think it is, because just like they were, I wouldn't say happy, but they tolerated inflation below target for a long time. Now they're saying that they are likely to tolerate inflation slightly above target for a long time too. So they're not saying inflation, we want inflation at 3, 3.5, 4, but they're saying that 2.5 is good enough for them to start normalizing policy. In which case, 2.5 to me becomes some sort of a floor. And if 2.5 is a floor, there is a danger that they touch 3. And that to me cannot be bullish long-term nominal bonds. Why would you want to own nominal bonds at 4.25 when you can own tips at 2% over inflation? So if CPI is going to be 2.5 at a minimum, 2% over CPI is 4.5. And if it's 3, it's 5. So you can see where I'm going with this. Why would you want to own fixed income if you can own tips, and really you are buying a very cheap option that you go from 2.5 to 3 and you earn substantially more in tips. To me, tips now are preferable to nominal bonds and will stay preferable to nominal bonds for the foreseeable future, unless CPI really starts taking a dramatic dive down, and they are saying that that is unlikely. Then tips over nominal bonds is going to be the game for several months. So I've updated up here the exact path that the Fed is predicting. It's basically still saying we want to start cutting in June regardless, and then we want to cut 3 times in 2024, probably every other meeting, and that's what we have, and 3 times in 2025, and probably every other meeting. So this is the exact path that they're projecting, and you can see from that that we are exactly where they are projecting the path to be. We are 10 basis points away, 10 basis points rich in Z4 and Z5, and 8 in M5. But that can be accounted for by the timing, the exact timing of when they cut. Nobody is going to try to arb this out, because if it's one meeting out that they cut, this is perfectly in line. And this is where we are likely to remain until we get data. What is the curve likely to do now? Well, not very much until we get the NFP, and not very much until we get the CPI. And the CPI is the one that could absolutely, blow their projections out of the water, because if it starts going up now, as opposed to remaining in a range, then these dot plots are completely meaningless, and they could start, absolutely, volatility could completely unpin, because if you can't trust the dot plots, you're going to go at least 25 basis points away from them. But that is not going to happen yet. And I will show you now what the MOVE index is doing. So here we have the MOVE index, and let's not forget that the MOVE index is slightly biased towards the shorter end of the curve, because it's short end heavy. Have a look at where we started breaking above these lines, the dotted and the solid. It was here, it was in early February of 2022. And each one of these low points, go and have a look, is exactly where the market bottomed and rates went a lot higher. And you can see why the MOVE index moved as it did when it started breaking these levels, and these levels have been very significant for a very, very long time. It was basically saying we are unpinning. We don't know where the top is in rates, and therefore options started getting more expensive. Volatility started going up. Now we're saying the opposite. We do think we know where we are going, and volatility is coming down. Why would that change? Well, that would only change if the data says that the Fed dot plots are complete rubbish, because CPI is nowhere near what they think it is, or what they think it will be, and therefore we cannot take any comfort from the Fed's dot plots. At the moment, we're saying the opposite. We're saying we believe the Fed dot plots. We are right on top of the Fed dot plots, as I just showed you. And therefore volatility is going to be very low, because we're not going to go very far away from them. And we believe that we can start normalizing the curve fairly soon, and that is June, right? That's what they're saying. And therefore we will end up with volatility where it was before the hiking cycle started, and that is in this area around the 60s. i.e. when the Fed moves very predictably, very slowly and just normalizes things, or it doesn't move at all. So this is saying that basically bond prices, certainly at the short end, are going higher. So prices are going higher, yields are going lower. This is what this chart is saying. And at the moment, there is no reason not to believe it. What there is a reason to believe is that if this does not work, the spikes are going to be of this dimension. Okay, it's going to go back to 140. And the reason why it wouldn't work is because the data disproves the assumption that the Fed is going to do what it says it's going to do in the dot plots. So we're getting at a dangerous point, at an inflection point. Either the data confirms it, in which case we go back down here around 60, or the data completely blows it out of the water, in which case we will go to 140. At the moment, the assumption has to be that we're going towards 65, so a normalization of the curve, and the first opportunity that we will get to disprove is going to be NFP. I mean, basically we know we're going to be looking at NFP and CPI, NFP, CPI, NFP, CPI. And if it's in line, it doesn't have to be better. Now, this is important. It doesn't have to be better than expectations. It has to be in line with expectations. Inline numbers will give the Fed confidence to start cutting in June. They've said that. I see no reason not to believe them. So unless expectations are for acceleration, and they're not, then inline numbers are good enough to get the move index down and rates down with it. So the story is, until any number comes out, the way to make money is to sell puts. You sell short-dated puts very close to at the money or slightly out of the money in 2s, 5s, 10s, and you will make money because the odds of the market going substantially higher in yield, lower in price, are not good until those numbers. The yield curve did remarkably little last week. It did steepen slightly, but very, very slightly, and far less than I thought it would, so I'm wrong. Here we have 2s, 10s. As you can see on the week, 1, 2, 3, 4, 5, it steepened, from 40 to 38, so 2 basis points, hardly anything. But the central tendency should be for the yield curve to steepen. I will be a seller of spikes upwards. I don't know why these spikes upwards should happen, but I will be a seller of them. 5s, 30s steepened more than 2s, 10s, but it's still marginal. To me, it makes no sense for the yield curve to do anything else but steepen. What have I told you so far? I've told you that I see absolutely no reason to prefer nominal bonds to tips, because the danger is that they tolerate 2.5 to 3, as opposed to trying to go the last mile by holding rates higher for longer to force it down to 2. They seem to be very, very afraid that something at some stage will break if they hold rates, real rates at these levels for such a long time. And therefore they seem to be hell-bent on cutting and saying that 2.5 is good enough. For the sake of 50 basis points in inflation, we are not going to risk the health of the economy. Well, that is bullish equities over bonds in the first place. So they're going to run the economy hotter. The equities should do better as a result than bonds. And why would the yield curve steepen now without, why would it flatten without data? I just don't see any reason for it. The only way it can flatten is if the data completely negates their theory and the move index starts going upwards rather than downwards. And it's not doing that, and it won't do that until NFP at the earliest, and that's another, well, let's call it 2 weeks between friends. And then you have what? Then you're looking for CPI the week after that, in the middle of April. And those are the only two real data points that can negate that the yield curve should steepen. I'm going to be a seller at 14, 15, and then if it gets to 10, I'll just say, hell, I'm wrong, the timing is wrong. That's all you can say. The central tendency should be to steepen. It's very anemic at the moment. I don't know why. I don't understand it. And when I don't understand, I tend to trade less. But in any case, around the CPI and the NFP, I would expect the yield curve to have steepened slightly more by then. And then we get the big reaction of the yield curve on those numbers. But if those numbers are in line and continue to be in line for a month or two, I would expect the yield curve to be down here by June. That's another 30 basis points of steepening by then, because that when they cut, we should be down here. Before I have a look at the 10s and 30s, let's have a look at where term premium is. Term premium is stubbornly stuck at 0. Even though we have a hell of a lot of issuance coming next week, and we know that we have a hell of a lot of issuance coming in Q2, term premium is at 0. Now, what are the odds that term premium goes far negative? Well, to me, not very good. It just isn't. And let's have a look now at the real interest rate on, say, 10s, and it's stuck around this 190, keeps on going up to 2, down to 188, let's call it 182% range. When you put those two together, it basically says that unless we see term premium go down a hell of a lot, or we see the real interest rate going down a hell of a lot, this chart isn't going to move very much at all. So now you're looking for 10s to be in a range between, I don't know, just above 4% to 430, 435. So this is likely to remain stable in a 30 basis point range, and all the movement in to steepen the curve should happen from the 2s and 5s, and that is all I can see happening in the near future. 10s and 30s should remain in a very tight range, certainly until NFP and CPI, and then make their move after that. But even that move at the longer end should have far less volatility than at the short end. The short end should be the one that responds more and most, and the long end should be the one that just accepts that movement, and basically, that's the way the yield curve moves. I think 10s and 30s are going to be fairly stuck, because I really don't see who is going to buy the 10s and 30s when they can buy tips and have far more certainty of higher yield, because 2.5 plus 2 is 4.5. And I don't see inflation going below 2.5. I think they could much more easily have accidents towards 3 than, below 2.5, in which case, why would you buy 430, 425 in 10s and 30s? I just can't see it. To me, whoever buys, 10s below 4% is a complete idiot. I will be wrong, but what can I say? I just cannot see a single reason for that to happen. And that is why I think that the only way the yield curve can move is to steepen via the short end coming down and the long end being completely anchored, because you have the term premia stuck at zero, and I can't see it living in negative territory with all this issuance to come. And we have real rates stuck in the range of 180 to 2%, and I can't see CPI below 2.5, and I can see it going towards 3 much more easily than I can see it going below 2.5, because the Fed is just not being tight enough and they want to ease regardless, it seems to me. And therefore, I really am not a buyer of long-term bonds. Everything that is happening in the US is happening exactly the same in Europe, and which is not surprising when we have a situation that the ECB wants to basically follow the Fed. It's waiting for the Fed to move as well. So it's almost a mirror image in Europe of what is going on in the US. And while the central bank situation remains the same, it's going to remain the same basically. Twos are stuck, fives are going absolutely nowhere higher. These levels have always proven to be wonderful sells in terms of yield, buys in terms of price, around the 240, anything up to this kind of level, 247 in fives proves to be absolutely the top, and then people just puke it out and it goes back down towards 227. I'm still thinking that eventually we see this 212 area, so I'm a buyer of bobble every time it gets up here. I just can't see that it's not a good buy. Tens I'm much less bullish, but I know that at some stage they're going to be trading this 221 area. It just is what it is. If we have a look at France, which trades technically almost perfectly. I mean, look at these, spike highs here around 296, 297, cannot hold, so it goes back down to 271, and we are at 279 now, and you know that at some stage next week it'll trade 271. So that is the range for the time being. It's not going to go a million miles away, simply because everything is stuck. And if you have a look at the cross between Germany and the US, here we are. Where did we move last week? Like 2 basis points in twos. Let's look at fives. What did we move? Nothing. And if we look at tens, what did we move? We moved in Germany's favor by a whole of 3 basis points. So that's all you've got to say. I think the tendency should be for, as inflation will be lower, without a doubt to me, in the EU, and growth will certainly be lower in the EU. The central tendency should be for a couple of basis points a week for this to go out, and that to me gives you a steeper curve in the US as a result, because Europe is favored over the US, more issuance in the US, and that should give you a steeper curve in the US. But at the moment it's just not. But I don't think there's a big trade here in the differentials. I think slowly every dip, I'm a buyer of dips, but I'm not a chaser. I don't think that this is going to move substantially until we get data that says that the EU needs to cut, it must cut, and stuff gets delayed for whatever reason, i.e. CPI numbers really, in the US. So until that, the market feels that relationship of symmetry between what the ECB and the Fed are going to do, and the timing becomes different, this is unlikely to move. The dollar index had a good week, primarily because the Swiss National Bank cut and the Japanese yen continued being relatively weak, because we all know that this is basically just about as high as short-term rates in Japan are going to go for a long time. It's going to be a long, long time before the Bank of Japan hikes again. And rates are now at zero, and they're going to stay at zero for a long, long time. It's going to take a hell of a lot of data to convince Japan that they are still too easy, and therefore, I really wouldn't expect Japanese rates to move very much from where they are now. What's the dollar likely to do? I still think it's in a range. I still can't see it being higher than this 101.58, 105.60, 80 area. To me, this is as high as it goes for the time being, and then it should probably just trade around as it is at the moment. I see absolutely no impulsion or reason for impulsion in the dollar, because as we just saw, the rates differentials are going to remain pretty stable. So, people are going to be buying the dollar on dips. They're not particularly going to be aggressive about it, because there's no particular reason to be aggressive about it. So stability, but I'm certainly not a seller of dollars. I just don't see any reason to sell dollars and buy euros. I mean, why on earth would you want to do that? Growth is going to continue to be stronger in the US. So buying dollars on dips is my strategy, but I just don't see any reason why it should start taking out, sort of these highs around 105.80. Don't see any reason for it, not immediately. Now, this is a chart of the differential between tens in Germany and tens in Japan. And you can see the failure last week, all right? We came back to below where we opened the week. And if you look at a longer term chart, I think that we are now topping out. And what does that say? So let's go with the narrative. Japan has hiked, and it's going to keep rates steady to at zero, and 10-year notes, JGBs, are not going to move a million miles from where they are now. The ECB is hopefully about to start its cutting cycle, and therefore you would have thought that this would start going down. This differential between Japan and and Europe would start going down towards these levels, right? So now let's have a look at euro yen. And here we have euro yen. It did exactly what I thought it would do. It stopped everyone out, and then it reversed. If I'm right in my belief that eventually the chart that I just showed you, the differentials go down towards the 75, 80 basis points, i.e. another 75 basis points of convergence in the difference between the 10-year JGB and Bund, then this is likely to start coming down, and coming down hard. The 200-day moving average will be the battleground, and I reckon the battleground is going to be in this area in a few weeks' time, around the 160. But from now on, every opportunity, every spike I get, I'm a seller of euro yen. I think that we've gone far enough, and that this trend should basically revert towards the 200 weekly moving average, somewhere around here over time, 150 to 147 to 150 over time. And we are probably 5-6% expensive here, and I think we will see it lower. Having taken out all the stops, I think I'm just going to job it and trade it to the downside from now on. gold did a perfect weekly doji, didn't it? So, what's it likely to do? Well, I think it always comes back to around this 2107 area. I think it probably will. It's just trading and stopping everyone out. It's just not ready, I don't think, to stay above 2200. I think it's going to take time. And that tells me that you're going to get relative stability in bonds. So around this 2100 level, 2108, you just have to be a buyer via options. I just would not chase it here. Real rates aren't really moving, and therefore I think people who got excited and started buying heavy gold up here are going to be disappointed, and they're going to be disappointed and stopped out. So to me, this 2108 to this kind of area, 2075, is a good area to accumulate and buy some options for more upside later on in the year. But I don't think it's a chase this market time yet. Whether you look at DBC or you look at oil or you look at copper or you look at gold or whatever, you're getting the same we are in consolidation and not in trend story. And therefore, I just can't see it really moving very far away from this 2288 in DBC. And I really can't see oil really moving very far from its central tendency to trade between 83, 84 and down towards 76, just north of 75. I think that is the story from the time being. And even if you look at copper, what are you seeing? You're seeing a range between 417 and down to 367. You're not seeing impulsion. You're seeing technical trading, and really you are not getting paid to take very much risk. I would leave commodities alone for the time being. I think they are in a 5-6 basis point percent range, and that is all there is to be said for it. And that is also why I don't think that inflation is going to accelerate above the 3% area. But I think because goods are just not going up, the raw materials aren't running away. They're firm in a range, nothing special, but that can only lead to maybe goods coming down, but services certainly aren't. And that tells me that inflation is going to be stable in that 2.5 to 3% area, and with more danger of upside than downside. And if that is so, that is why I have the bond view that I have. I have the commodity view that I have. I have the gold view that I have, that it's better to buy the dips rather than chase now, because there isn't going to be any dramatic upside in inflation, and therefore why chase something that's already gone up several percentage point. Everybody got stopped out who was short. Everybody got taken out, certainly up here. And now, we can drift back to 2100, consolidate, and maybe go towards the end of the year. But for the time being, I don't see gold being a particularly good hedge of anything. I see no particular reason why there should be a big dramatic change in this chart. I think it's just going to slowly wiggle its way up. This is SPY over TLT, SPY over IEF, SPY over SHY. So basically the whole curve, it's just what it is. If the Fed is happy to run the economy slightly hotter with slightly higher inflation around the 2.5 to 3% area, and that is good enough for the Fed, it's going to be good enough for the stock market. They're going to just basically, every time it dips, they're going to buy stocks and sell TLT. Every time it dips, they're just going to continue doing that. There is no recession coming. Unemployment claims are low, jobs are plentiful. There's just not going to be a dramatic change in this relationship for a while. We will need to see a lot more data before we can say that there is any reason to prefer bonds to equities. Until and unless we see a breakdown of this 5180 area, and we can enlarge this chart and have a look, this is basically the range that we were in for best part of 2 weeks, and then we busted it on Fed Day when the Fed basically told us they're going to run the economy hotter. So unless we start closing below 5180, there really is not a lot of reason to think that we are going to have much more than a wiggle up and down before we start the continuation up. So if I don't think that long bonds can do very much better, then the only way that that chart of SPY over TLT can do better over time is if SPX does better over time. And really it's just a question of time, really, to me, because before we start going back up, I just don't see anything that's going to stop equities for the time being. We certainly are ridiculously overbought on the technicals in every single possible way on the weeklies and the monthlies. But that does not really mean all that much. It just means that we might get 2-3 weeks of going sideways to testing some downside. But that is in no way a change of trend. So am I buying equities right here and now? No, I'm not. But I'm looking to buy the dips. If we get some dips below that Fed level and around 51.85, and then people start getting all bearsed up and silly, and we start trading 5100 to 51.25, or even down in the 50/50s, I'm going to be a buyer. I'm going to be an options buyer. I think 2 or 3 weeks of sideways to down would do us a lot of good. I don't think that the market can just keep on going and chasing. I mean, look at this RSI on the weeklies, around 80. We're hugely overbought, and we're very rich on valuations. We're running on fumes as far as that is concerned. But I just think that the relationship to other assets is not in ridiculous territory. And therefore, if we start going sideways for a few weeks, I will be a much better buyer. Something like this kind of level, 5100. I really wouldn't mind buying that kind of level. There are no particular warning signs from any of the foreign markets. They're just, trading around and underperforming sometimes, outperforming other times the SPX, but the relationships are being pretty constant. And really, there is nothing much to worry about in any of those charts. Would I prefer to see a pullback? Absolutely. Am I going to be that lucky? Probably not. So none of the foreign charts, whatever I look at, whether it's stocks, whether it's Nikkei, EM, whatever, it says that we are going to suffer anything more than a temporary correction at best. And there are no long-term warning signs from any of them. I think just like with SPX, a couple of weeks of sideways would do us a huge amount of good. Next week, I think, is going to be particularly quiet because it's a holiday shortened week, but also all we have is auctions and very, very secondary data. Unless we get some geopolitical news, we are probably going to be in a quiet range, and that is what those levels reflect. I'm not a buyer of 10s and 30s. I'm looking for opportunities to steepen the curve, for levels to steepen the curve, and I'm really looking for opportunities to the downside in equities to buy them. I don't think next week is going to be the week that you get a serious dip that is buyable. I think it's more likely to go sideways and you wait for the week after to get the dip. But there you go. That's what I think currently. I hope you've understood the reasons why I think that long bonds are just not a buy. And therefore, if I can't buy long bonds, equities, it suggests to me that equities might be in a range to slightly weaker, simply because if bonds don't perform, then equities outperform by doing nothing, if you know what I mean. So those are my current thoughts, and I will tweet you on Monday. Have a great weekend.